The Northeast housing market is not crashing in flames. It is tightening in silence. Listings linger where bidding wars once erupted in hours. Sellers hold firm on prices that buyers can no longer finance without strain. Beneath the calm surface, something structural is shifting, and the consequences are spreading from Boston brownstones to suburban cul-de-sacs in New Jersey. In the winter light that falls across the brick rowhouses of South Philadelphia and the triple-deckers outside Boston, the Northeast housing market appears intact. For sale signs still stand upright. Brokers still host open houses on Sunday afternoons. Closings still take place in conference rooms where paperwork moves from one side of the table to the other. Yet beneath these familiar rituals, the market's internal mechanics are misfiring. The change is not dramatic enough to command headlines every week, but it is consistent enough to alter behavior across buyers, sellers, lenders, and municipal planners. The story begins with interest rates. When mortgage rates rose sharply after years of historic lows, they did more than increase monthly payments. They redefined affordability across the entire price spectrum. In cities such as Boston, New York City, and Philadelphia, where median home prices had already climbed steadily through the 2010s, even a modest rate increase translated into hundreds of dollars more per month. Buyers who once qualified comfortably found themselves recalculating debt-to-income ratios. Pre-approval letters shrank. The psychological ceiling for acceptable payments lowered. At the same time, sellers were anchored to valuations set during the pandemic boom. Between 2020 and 2022, low borrowing costs and remote work reshaped demand. Urban renters sought more space. Suburban homes with extra bedrooms and modest yards became highly competitive. Bidding wars normalized. Appraisals struggled to keep pace with escalation clauses. That period established a reference point in the minds of homeowners. When rates later rose and buyer demand cooled, many sellers did not immediately adjust expectations. They listed at yesterday's peak and waited. Waiting has become a defining characteristic of the current Northeast market. Properties remain on the market longer than they did during the frenzy years. Days on market metrics have expanded from single-digit figures in some neighborhoods to several weeks or months. This elongation is subtle but meaningful. It signals that the balance of power has shifted, though not decisively toward buyers. Instead, it has settled into a standoff. In suburban counties surrounding Newark and Hartford, brokers describe a pattern. Listings arrive at aspirational prices, receive modest traffic, undergo one or two incremental reductions, and eventually transact slightly below the original ask. The corrections are incremental, not catastrophic. Prices are bending rather than collapsing. Yet when this pattern repeats across thousands of transactions, aggregate data begins to flatten. Appreciation slows. In some zip codes, it reverses marginally. The Northeast differs structurally from Sun Belt markets. It is older, denser, and more constrained by geography and regulation. Zoning laws in many municipalities limit multifamily construction. Historic preservation districts restrict redevelopment. Land is scarce. These constraints historically supported price resilience. However, they also inhibit supply adjustments. When demand softens, there is limited capacity to lower price points through new, less expensive construction. The result is a rigidity that magnifies affordability pressures. Affordability is not an abstract metric here. It is a lived reality. In parts of Providence and New Haven, median household incomes lag behind housing cost growth. Renters attempting to transition into ownership confront down payment requirements that have outpaced wage increases. Even households with stable employment in healthcare, education, or government, industries that dominate much of the Northeast economy, find themselves constrained. The entry-level market, once fueled by first-time buyers leveraging low rates, has thinned. The condominium segment reveals additional stress. Urban condos in central Jersey City and sections of Brooklyn experienced strong demand during the pandemic's early suburban migration reversal. Yet higher association fees, rising insurance costs, and special assessments tied to aging infrastructure have complicated affordability calculations. Buyers scrutinize building reserves more carefully. Lenders apply tighter underwriting standards to condo projects with high investor ownership ratios. Transactions slow not because units lack intrinsic value, but because financing pathways narrow. Inventory levels provide another layer of complexity. In absolute terms, available homes remain historically limited. Many homeowners secured mortgages below 3% during the refinancing wave. To sell now and purchase another property at current rates would dramatically increase their borrowing cost. This rate lock-in effect discourages mobility. Families that might otherwise upgrade remain in place. Empty nesters postpone downsizing. The expected flow of existing homes into the market is reduced. Reduced inventory would normally support prices, yet demand is equally constrained. The market thus operates in a compressed equilibrium. Low supply meets cautious demand. Transactions occur, but volume declines relative to prior peaks. Real estate professionals feel this contraction first. Brokerages report fewer closings per agent. Mortgage originators face thinner pipelines. Appraisers and inspectors experience uneven schedules. The ripple effects extend to municipal finance. Many Northeast cities rely heavily on property tax revenue. When transaction volume slows, transfer taxes and recording fees decline. While assessed values do not immediately adjust downward, stagnation introduces budgetary uncertainty. Urban planners watch closely, aware that prolonged softness could limit funding for infrastructure and public services. There is also a demographic dimension. The Northeast's population growth has lagged behind other regions of the United States. Some areas experience net outmigration, particularly among younger households seeking lower housing costs elsewhere. States like Massachusetts and New York retain strong employment centers in finance, technology, and education. Yet housing costs act as a filtering mechanism. Graduates from universities in Cambridge or Manhattan may accept initial employment locally, but long-term homeownership plans increasingly involve relocation. This gradual outward movement influences suburban markets in upstate New York and western Massachusetts. Towns that once absorbed spillover demand now observe moderation. Commute patterns shift as hybrid work models persist. If employees commute only 2 or 3 days per week, proximity to downtown offices becomes less critical. However, the savings from moving farther out must offset higher mortgage rates. In many cases, the arithmetic fails to justify a move. Investors, who played a visible role during the low-rate period, are recalibrating. Institutional buyers that acquired single-family homes for rental portfolios now confront higher financing costs and slower rent growth. Cap rates adjust upward as borrowing expenses rise. In parts of Baltimore and southern New Jersey, smaller investors hesitate to expand portfolios. The investment thesis remains intact. Housing is a tangible asset with inflation-hedging characteristics, but short-term returns compress. Construction activity reveals another facet of the slowdown. Permits for new single-family homes in many Northeast states have plateaued or declined. Developers cite input costs, including labor and materials, that remain elevated relative to pre-pandemic levels. At the same time, buyer traffic at model homes has cooled. Projects proceed cautiously, often in phases, to avoid oversupply. Multifamily construction continues in select urban corridors, yet lenders scrutinize feasibility studies more rigorously. Insurance costs introduce an underappreciated strain. In coastal communities from Long Island to Cape Cod, premiums for homeowners' insurance have risen in response to climate-related risk assessments. Flood zones and storm exposure are priced more aggressively. These increases, while incremental annually, compound over time. Prospective buyers incorporate insurance into monthly payment calculations. In marginal affordability cases, the added expense tips decisions toward renting or postponement. Psychology plays a subtle but powerful role. During the boom years, urgency dominated. Buyers feared missing out. Sellers anticipated multiple offers. That momentum reinforced itself. In the current environment, caution replaces urgency. Buyers deliberate longer. They request inspections more consistently. Contingencies reappear in contracts. Sellers, recognizing the shift, invest in staging and minor renovations to differentiate listings. The tempo slows, yet this is not a uniform collapse. Prime properties in desirable school districts or near transit hubs continue to attract attention. In certain neighborhoods of Arlington and suburban Boston, well-priced homes still generate competitive bids. The differentiation between average and exceptional listings has widened. Pricing strategy becomes critical. Overpricing results in stagnation. Realistic pricing can still produce efficient outcomes. The quiet breaking of the market lies in this divergence. Data aggregated at the state level may suggest stability. Median prices might show marginal year-over-year gains. But within those averages, transaction velocity declines, concessions increase, and the margin for error narrows. Households stretching finances to purchase at elevated rates face heightened vulnerability to economic shocks. A job loss or unexpected expense carries more weight when monthly housing payments consume a larger share of income. Financial institutions monitor delinquency rates carefully. Thus far, widespread distress has not materialized. Borrowers generally entered this period with stronger credit profiles than during previous housing downturns. However, early signs of stress appear in specific segments, particularly among recent buyers with minimal down payments. Adjustable-rate mortgages, though less prevalent than in past cycles, introduce additional sensitivity to rate changes. All of these forces converge quietly. There are no foreclosure waves dominating headlines. There are no blocks lined with vacant homes. Instead, there is a gradual recalibration occurring across thousands of individual decisions. Buyers decide to wait, sellers decide to hold, developers decide to pause, lenders decide to tighten. Each decision is rational in isolation. Collectively, they produce a market that feels stable on the surface, yet structurally strained beneath. As winter turns to spring and the traditional peak selling season approaches, expectations are tempered. The Northeast housing market has not shattered, but it is no longer buoyant. It is absorbing pressure from higher borrowing costs, demographic shifts, regulatory constraints, and psychological recalibration. The breaking is not audible as a crack. It is perceptible as resistance, as friction in transactions that once flowed smoothly. The question is not whether the market survives. It almost certainly will, but how its internal structure will adapt to this prolonged period of tension. By early spring, the transactional machinery of the Northeast housing market resumes its seasonal rhythm, but the cadence remains altered. Open house signs reappear at intersections in Westchester County and along quiet streets in suburban Connecticut. Agents circulate updated comparative market analyses. Yet the conversations inside living rooms and at kitchen tables have changed tone. Buyers ask not only what a home is worth today, but what it might be worth in 5 years under persistently higher interest rates. Sellers ask whether holding out for last year's price is prudent or counterproductive. The structural tension that defines this period is rooted in arithmetic. Mortgage rates, even if they fluctuate modestly, remain elevated relative to the ultra-low environment that preceded them. A household purchasing a $700,000 home in parts of Stamford or northern New Jersey now faces a monthly obligation substantially higher than a comparable buyer would have faced 2 years prior. This difference is not abstract. It constrains discretionary spending, retirement contributions, and emergency savings. Housing once again competes aggressively with other financial priorities. Wage growth in certain professional sectors partially offsets these pressures, particularly in finance and technology corridors linked to Manhattan and Boston. However, wage gains are uneven. Public sector employees, healthcare workers, and service industry staff, who form the backbone of many Northeast communities, experience more modest income adjustments. The divergence between housing costs and median earnings widens. The concept of house poor, long familiar in high-cost regions, becomes more prevalent. Rental markets provide limited relief. In cities such as Albany and Buffalo, rents climbed during the pandemic as demand for space increased. Although rent growth has moderated, it remains elevated relative to historical norms. Prospective buyers comparing mortgage payments to rent find neither option inexpensive. The traditional pathway, rent while saving for a down payment, then purchase, extends in duration. Savings targets rise as home prices remain high. The generational dimension intensifies. Millennials, now firmly within prime homebuying age, encounter a market defined by constrained inventory and higher borrowing costs. Many entered adulthood during the aftermath of the financial crisis, delaying wealth accumulation. Now, as they seek stability for growing families, they confront structural barriers. Intergenerational assistance, in the form of parental gifts for down payments, becomes more common in affluent suburbs around Princeton and the North Shore of Massachusetts. This dynamic reinforces inequality, as households without such support struggle to compete. Meanwhile, older homeowners assess their positions differently. Those who purchased decades ago at substantially lower price points possess significant equity. Yet the incentive to sell is muted by the prospect of assuming a higher rate mortgage on a replacement property. Some choose to renovate instead, investing in additions or accessibility modifications to age in place. Contractors in suburban Rhode Island and New Hampshire report steady demand for home improvement projects. This choice removes potential listings from the resale market, perpetuating inventory scarcity. Local governments face policy dilemmas. Efforts to increase housing supply through zoning reform encounter political resistance. In established communities near Newton and Westchester County, proposals to permit higher density developments provoke debates over school capacity, traffic, and neighborhood character. Advocates argue that without supply expansion, affordability will deteriorate further. Opponents worry about strain on infrastructure. The result is incremental change rather than sweeping reform. Credit conditions add another layer of constraint. Banks, mindful of broader economic uncertainty, tighten underwriting standards. Higher credit score thresholds and stricter income verification processes reduce marginal approvals. Non-bank lenders fill some gaps, but at pricing that reflects elevated risk. The accessibility of credit becomes more stratified. Well-qualified borrowers secure financing, albeit at higher rates. Borderline applicants are deferred. The quiet break in the market is visible in concessions. Sellers increasingly agree to cover closing costs or fund temporary rate buydowns to facilitate transactions. Inspection contingencies reassert importance. Requests for repairs, once waived in competitive bidding environments, are negotiated in detail. These shifts do not necessarily reduce headline sale prices dramatically, but they erode net proceeds. The effective price of homes adjusts through side agreements rather than overt markdowns. Commercial corridors in smaller cities illustrate indirect effects. When residential transactions slow, associated spending on furniture, appliances, and renovation materials moderates. Retailers in downtown areas of Portland and parts of upstate New York observe softer demand. The housing market's health influences broader local economies, particularly in regions where real estate activity constitutes a significant share of employment. The question of future price trajectories dominates professional discourse. Economists debate whether the Northeast will experience a gradual nominal decline, a prolonged plateau, or a renewed upswing if rates ease. Historical patterns suggest that constrained supply can buffer downturns. However, sustained affordability pressures risk suppressing demand for extended periods. The market could enter a state of low turnover and minimal price growth, a form of stagnation that feels stable yet restrictive. Climate considerations increasingly inform buyer decisions. Coastal flooding risk, heat resilience, and energy efficiency matter more in underwriting and personal preference. Homes with updated insulation, modern HVAC systems, and elevation above floodplains command relative premiums. Older housing stock, prevalent throughout the Northeast, requires capital investment to meet contemporary standards. Buyers factor anticipated renovation costs into offers, further moderating bid levels. The labor market's trajectory remains pivotal. If employment remains robust in metropolitan anchors like New York and Boston, housing demand will persist, albeit at adjusted price points. If economic contraction emerges, pressure could intensify. Thus far, unemployment levels have not surged dramatically. This stability underpins the absence of widespread distress sales. The market's quiet strain is therefore a function of affordability compression rather than systemic credit failure. Real estate professionals adapt strategies accordingly. Marketing timelines extend. Digital outreach supplements traditional open houses. Pricing discussions become data-driven and cautious. Agents counsel sellers to align expectations with current buyer capacity rather than past peak comparables. In neighborhoods where multiple listings compete, differentiation through condition and presentation proves decisive. For individual households, the experience is personal rather than statistical. A young couple in suburban Connecticut calculates whether to allocate a disproportionate share of income to secure a modest starter home. A retired homeowner in upstate New York debates selling a long-held property, but hesitates at the prospect of renting in a tight market. A mid-career professional in New Jersey postpones relocation because the financing gap between current and prospective mortgages is too wide. Each decision reinforces the market's restrained tempo. The Northeast housing market is not unraveling through visible collapse. It is adjusting under pressure, its components responding to altered financial physics. The break is subtle. Transaction volume declines, affordability narrows, mobility slows, and confidence moderates. There are no dramatic cliffs, only a persistent incline that buyers must climb and sellers must acknowledge. Over time, markets equilibrate. Interest rates may stabilize or decline modestly. Supply reforms could incrementally expand inventory. Wage growth may partially bridge affordability gaps. Yet the period of effortless appreciation that defined the early 2020s appears concluded. In its place stands a more deliberate, constrained environment. The phrase, quietly breaking, captures not destruction but strain. The Northeast housing market is absorbing forces that challenge its traditional resilience. Dense urban cores, affluent suburbs, and aging industrial towns all experience variations of the same theme: higher costs intersecting with finite incomes. The outcome is neither dramatic collapse nor triumphant recovery, but a measured recalibration whose full implications will unfold gradually. In the end, the Northeast remains defined by its structural characteristics: limited land, established institutions, diversified economies, and enduring demand to live near centers of culture and commerce. These features provide ballast, yet ballast does not eliminate tension, it distributes it. The market continues, transactions close, families move, and communities evolve. But the ease that once defined the housing landscape has been replaced by calculation. And in that shift from momentum to deliberation lies the true measure of a market quietly under strain.